Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us on this November 10th edition of the Market Carver. Going to be a short and sweet one. Between now and the time that this airs, we've got an election and results, and I'm sure a few sectors will be moving by this point in time. So look forward to hopping on next week and kind of giving you an early preview of the things that we're spotting after that. But as far as this week goes, we're going to talk about the results from the Fed meeting and alert you to things that they're looking at, update you on earnings, and then Andrew on something that he shares with us on the investment side each and every week that we filter in and share with you periodically. So I thought it was at a good point to share with you guys this week. But we're going to start off with the Fed. By far, I think the dominant theme of this year and the relentless surge in interest rates. But there was a small change in this meeting, and I'll explain what the two different charts are here in a second. But the focus over the past several meetings has been the pace. How much is the Fed raising rates at once? How quickly are they getting them up? And to that extent, it was really aggressive. 0.75 for a series of meetings. And so the Fed's shift of focus this time is much less about how quickly they will move. Instead, how high will rates need to go? And very insistent that they are going up higher than the market was giving them credit for. The market got that message. The yellow line is a forward look at where the market expects interest rates to be over time. Just focus out on into May, which is where most of the market believes the peak in rates will be. And you can see that shift up quite a bit after in between October 27th and November the 3rd, once the Fed had gave their updated meeting and the interest rate increase in their outlook. So shifting that focus, it's much less about whether it's 50 or 75. And instead, Powell wants the market to get this message that they are indeed going to keep going higher and ultimately up and well above 5%. So of course, it's no guarantee that they ultimately do that. There's a decent chance that the market corrects things for them. And that in large part is what Powell wants to see. He wants to see asset prices come back down and wants to see the economy adjust without actually having to push them that high. But for now, that is the plan as far as the Fed is involved. And shifting now to earnings. If you were with us at the Thirdly last month, one of the things we talked about was the earnings outlook. And if there was a major concern from this point, so this was late September, early October when we were having these meetings closer to the bottom. And if we were concerned about one door being opened for lower, as far as the S&P 500 is concerned, not quite the same thing with smaller companies, which had a brighter outlook, but that is that the earnings outlook had largely stayed intact. Meaning as we looked out into the future, even though the odds of a recession had been rising, that for the most part, analysts expected earnings for companies to stay pretty strong. So those two things need to be reconciled, and we are starting to see some shift there. Andrew brought this to our attention on Monday, that blue line, we'll call it, showing you that the 2023 estimate, so the outlook for next year, actually starting to shift and go below 1 and recognizing some contraction. Now, I don't think that's really hugely made surprise by a lot of the stock prices, which have built in this already, but it is notable that those earnings are trending down. I'd say the biggest concern at this point in time is the margin compression that is happening within those. And if those margins are to stay contracted or even go worse into next year, that line could continue to go south. But it's certainly something that we watch and watch like a dog with laser focus, at least for the companies that we own, and staying updated with what their outlook is. And Andrew, I'll pass this over to you. You did a great job of sharing this with us yesterday in our investment meeting. So I'll let you add to that and then take over with the S&P daily chart.
Thank you. Yeah, so as Adam said, that we're having election day. We record this on Tuesday. It's election day. We'll likely knock on wood know the results when you watch this video on Thursday. But what things that matter the most to the market, what matter the most to us, are the first chart Adam shared about the Fed, this chart looking at earnings, and the third chart that we're going to look at next, looking at the actual price action for the market. It's less so impactful for what's going to happen on election Tuesday. But looking at this chart specifically, earnings, like Adam said, they're starting to dip lower. The expectations for next year And a large chunk of that is due to the compression in margins. We had a really long period, over a decade, of margins expanding. Companies were doing really, really well, specifically in the tech space. And now they're starting to see that be able to be a little bit harder to manage. We're seeing a lot of technology companies begin to lay off staff or slow spending, expansion. And it's really now kind of that shift toward more real economy, energy, materials, industrials, part of the economy that are starting to flourish and starting to grow again. And so this is a natural part of the economic cycle where we see what was strong become weak and what was weak become strong. Unfortunately, right now, the large chunk of the market is technology. So when tech is under pressure, it's going to have a negative impact to the entire earnings outlook. This doesn't mean that the entire market is going to be under pressure, but a large chunk of it is. There still leaves ample opportunity in other parts of the market. Like I said, industrials and energy and many other places that we're constantly on the lookout for earnings growth. But right now, when we look at the entire S&P 500, the earnings expectations right now, as Adam said, are starting to drift lower, making for maybe a potential rough start to the new year when we get into 2023. Now, taking the shift from that, looking now at the actual market, looking at the price action, the things that if you've been watching these market carvers for a long time, know that I'm often focusing on it and watching is the daily fluctuations and moves within the price. And so here's a daily chart of the S&P 500. There's a lot going on in this chart. We share it, like Adam said, every couple of weeks just to provide an update with what's going on in the broad market. What we have here recently is we had that undercutting, that new low that happened back in October. We came and tested that 200-week moving average, that green line on the bottom, came in as support, and we saw the market bounce. Now we're trying to determine, is this another counter trend rally like we've seen throughout this year, where we see multiple weeks of strength that then get sold off, or we finally start to see a durable low? It's obviously well too early to make that judgment call, but what we want to start seeing is a change in characteristics of the market. We want to start seeing levels of resistance be broken, and unfortunately, we're just not there yet. You can see that we got back above that dark red line, the 52 moving average, and then came back below it. We're continuing to see resistance levels come into the market, which tells us that there's still a little bit too much supply versus demand. To have a bull market, to have an uptrend, we need to have more demand than supply. And we're just not seeing that shift just yet. Maybe as we move into the end of the year, that will change. But as of right now, we're continuing to see stocks be under pressure, at least from a broad market perspective. But we are continuing to see sector strength in places like energy, again, in industrials. The Dow is doing better. Small cap stocks have also started to improve. And we've made some adjustments to the portfolios in that regard. So we are seeing some bright spots where things are beginning to strengthen. But when we look at the large cap market, it continues to be still in a downtrend and still seeing a little bit heavier supply, a little bit more sellers coming in than buyers at this point. But we continue to monitor this closely and look for those bright spots and hope to share them with you when appropriate.
Very well. Thank you, Andrew, for that great summary. And I appreciate you all for giving us a few minutes of your time. We do give you a weekly reminder that if we don't have the pleasure of working with you, to please give us a call. We'll have that opportunity to sit down with you in a no obligations first meeting, 800-928-4001. And for those of you that have been with us for a while, I can't say enough how much we appreciate you, especially if you're willing to give a few minutes of your time to actually watch these videos on a weekly basis. And I hope you all had a great week, got the chance to get out and vote and take that with the utmost gratitude, as we certainly do here at Financial Enhancement Group. So thank you again, and everyone, please have a great weekend.